Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for the segment, we have Chuck Fuller, Portfolio Manager with Nasdaq Dorsey, Wright, to discuss sector and asset class rankings and if we are starting to see any capitulation in the indicators. Chuck, it's great to see you again. Welcome back to Trade Talks. And to kick off here, give us an overview on how you arrive at sector and asset class rankings. What's the methodology at Dorsey, Wright?
Yeah, so at Dorsey Wright, we use what's called relative strength. It's kind of an older term for momentum, if you've ever heard that. And the basic idea is that, stocks or asset classes or sectors, pretty much whatever you're looking at, if you look at past returns, they tend to be predictive of future returns. Basically, stocks have gone up the most in the past, tend to go up the most in the future. Certainly not always the case, but there tends to be a correlation there.
Let's review the asset classes, starting with U.S. equities. Are you starting to see some capitulation, and where's the relative strength within this asset class?
Yeah, so the relative strength has come down some. Obviously, April was like the 7th worst month of the last 20 years. And May hadn't started out much better. So those rankings have, or not the rankings, but the actual scores that make them up have come down. It's still the second ranked asset class out of the 6 that we track, or at least 6 big asset classes. But we are starting to see some indications of some capitulation. We have an indicator we follow called the NYSE high-low. It kind of looks at the number of stocks on the NYSE making new highs versus new lows, and that's down at 6%, and that ranges from 0 to 100%. So the fact that it's at 6 is, it's pretty low. And the forward returns, when you look at other times in the past that it's gotten down to these levels, it tends to be pretty good, up around 20% or so going forward, like a year from now. Certainly that's not the case every time. Those are average numbers. So, we'll have to see how this one actually plays out. Some of our other short-term indicators haven't gotten as, oversold this time. And I would say partially that's because, not everything in the market is going down at the same time, like we've seen with some of these other corrections, the last 10 or so years. This year you've got energy that's up 40%, which is pretty startling. We're only, 4.5 months into the year, and to have a sector up that much is pretty wild. But, so we think we're seeing some signs of capitulation, and luckily we haven't seen, the relative strength really give it up quite yet in U.S. equity. So we're still, hoping for the best, but preparing for the worst.
Yeah, that NYSE high-low at 6% is pretty glaring there. Do commodities still head up your asset class rankings?
They do, right. So they've been there for a little while, at least the last few months. They're really, the gulf between them and U.S. equities at number 2 has gotten wider with the way that equities have been performing over the last month or so. But within commodities, it's roughly the same as what we have seen. Energy is still number 1. Which makes sense. You've got, things like natural gas that have doubled basically, already year to date. Heating oil, gasoline obviously is high up there when you look at year-to-date returns. Number 2 for us is agriculture. So think about things like wheat, things like cotton, various other agricultural commodities like that. Wheat obviously being high with all the issues over in Russia and Ukraine. And then industrial metals, that's kind of been one of the things that we've seen a change in, where they've fallen to number 3 out of the 4 commodities rankings. And then precious, they've had a pullback. They haven't been performing as well as these other guys anyway, but they've had a kind of a nasty pullback the last month or so.
And Phil McIntosh, Nasdaq's chief economist, came out the other week saying that this was the worst start to the year for U.S. bonds since 1788. What are your indicators saying?
Yeah, I saw that and that just left me speechless. I've heard of that it's as bad as since the 70s and that kind of thing, but the 1780s, it's unbelievable. And from what we're seeing, obviously things have gotten overdone on our indicators. We would expect to see at least some kind of regression to mean, which at least on the 10-year that would bring it back to maybe around 2.6%. And with the rate volatility that we've seen, that's more on the cards than you would think, even though that's a pretty drastic move. Where we've actually seen on the aggregate bond index that it's close to breaking through resistance, really for the first time in months. Really this fixed income drawdown has been really a stair step straight down. You haven't seen much in the way of big kind of bear market rallies like you've seen to a certain degree in equities. Just been really straight down. But the relative strength, we're not usually the type that are looking to catch bottoms. Relative strength is more of a long term, kind of trend following approach. So in terms of that, the relative strength is still pretty poor in fixed income. Cash has actually moved ahead of it in those asset class rankings that we talked about. And within the space, really it's short term or short duration treasuries and inflation protected bonds. It's kind of the I would say the top two places that we see from a relative strength perspective within fixed income. And those are the ones that are most defensive typically. So it kind of makes sense that that's what we're seeing.
All right. Appreciate the insight as always, Chuck. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Yeah, thanks for having me.